at. So the first objective which comes up here is a corporate tax overview and implementation objective. So my take or my understanding is, let's understand what is the objective, why this tax is suddenly coming up in UAE. Is there some agenda through which it is coming up, or it is pure just a collection of revenue? So if you believe it's pure a collection of revenue, then we are missing a broader link, because revenue collection, this country or this region has many more mechanisms of collecting the revenue. It is much beyond and much over and above than what we are talking about. Just a suggestion, if you are not speaking, then maybe if you can put yourself on mute, so that we don't get any background sound on that. Thank you. Thanks for understanding. Since I am on the presentation mode, I'll not be able to see any questions or any comments which come on the chat window. Maybe if someone from AAA can help me articulate if there's some question comes up, so I can just look at the question and answer it out. Now, starting with the implementation objective, the biggest thing which we see is OECD. Now, what is OECD? Why it is coming up? What kind of action plan they are looking at? I'll just go through one specific action plan which has come up, which is base erosion profit shifting. We have seen or we have heard this section before also when we did economic substance regulation or country by country reporting. Those were the places where we heard about this BEPS framework. But what BEPS framework talks about, I'm not going to pick up the whole activity or whole action plan, but yes, definitely something which is directly or indirectly related with tax, income tax. So the biggest issue which globally people are facing, not only the developed countries, but underdeveloped countries also, that the tax-based erosion and profit shifting is happening, one, because of the way we are operating right now. We have physical boundaries, but technically speaking, if you see from a business perspective, the boundaries have lost, because maximum business is done through online channel, through digital platform. The transportation logistics have become so convenient that anyone at any part of the world can book the shipments or provide the services from any part of the world to any other place. So the objective is how we can make sure that the country which has a right to collect the tax is collecting effectively. So that is where the BEPS framework comes into play. We all know taxation plays an important role in maximum developed and underdeveloped countries, where this becomes the only source, I will say the major source, to collect the revenue and make sure that public facilities are provided to, one, for the infrastructure development, for the country development, for security reasons, another factor. Apart from that, even to take care of underprivileged people, because these are the taxes which comes and converts into subsidies or comes into some kind of a grants which are provided to people who may not be privileged as we are talking about. So that's a holistic framework which comes and plays an important role. Now, developing countries' higher reliance on corporate tax means they suffer from BEPS disproportionately. So when let's take about any country. If even I'm not agnostic to any country specific, but we can pick up any country from Africa continent to European countries to even US also, where they're facing a lot of issues on account of people not paying tax appropriately, or they're shifting their base. That means they shift their profits from a taxable jurisdiction to non-taxable jurisdiction. So that's where BEPS framework, which is being spearheaded by 141 plus countries, and they said that let's do something jointly and let's work in an effective way so that we can control these aspects. Now, business which operates internationally, government must act together to tackle BEPS. That's what it comes into. Broadly speaking, I think this is quite underestimated numbers. 100 to 240 billion USD is lost revenue annually on account of shifting profits or on account of not paying taxes adequately as it is required to be done. Now, in this case, what happens is the OECD or G20 countries, which included as a part of framework, they got 141 countries together. That means 100 countries and jurisdictions are implementing 15 actions to tackle tax avoidance. Now we will talk about what is the 15 actions. I'll not go much into detail, but I just want to give you a framework that what we are doing and why we are doing it. What will definitely come with a lot of questions which tax authorities has started playing it out, but why is also becoming a critical and important part to understand the depth and importance why this legislation is coming to this part of the world. Now this is where, as I just talked about 15 action plans. So these are the action plans which are being designated through the base erosion profit shifting framework. Now, if you see these actions, these are quite related, and some of the actions we have seen how it is implemented in UAE and how these are being attached or aligned to. Now, first comes the action number 1 comes as tax challenge arising from digitization. Now, when we say digitization, we are not talking about only digital activities or transactions. We are talking about connect. The connect has become so easy. The goods, services, or any kind of infrastructure activity can be provided to any other part of the world without having, as I said, psychological barriers. Now the barriers are more in the maps is what we always believe now. However, from a trade perspective, those barriers have lifted. So that's where this is a big challenge which is coming up. You must have heard about the top companies where they are into digital world, pure digital world. That means they have a social network, websites, and all those things. And they end up having their parent company or the base company, which is under the tax haven or no tax jurisdiction, or even less tax jurisdiction, and end up not paying taxes even for the legitimate income which is earned in the taxable location. So that's where the challenge came from a UAE perspective also. As we know, as we stand together, UAE is not a federal tax country. I'm going to talk about more on what is federal tax. UAE still have taxes, but not at a federal level. So we are going to pick up those as some of the elements. Now, this tax challenge arising from digitization became so big that they need to come down and talk with all these 141 countries and see where and what can be done. So that's the first action plan which comes into. Action 2 came is neutralizing the efforts of hybrid mismatch arrangements. In a lot of countries, what happened, you have country taxation law. I'll just give a very simple framework. In one country where you say that, okay, whatever income you earn and dividend you declare will not be taxed because it is going to the other country. Another country may tax that dividend. So let's not have a second dual way tax system. Whereas in one of the country, what happens is dividend becomes a non-taxable because of the country legislation. So in total, what happens is end to end, one country pays dividend assuming that the other country will charge. The other country is not charging dividend, assuming that the first country which has transferred the dividend must have charged as a part of an income. But technically speaking, nothing happened. So in this case, there are some kind of a tax practices which are not aligned. So they want to see that how we can neutralize it. It should not harm neither positively, neither negatively. So we should not have a situation of dual taxation also. And we should not have a situation of no taxation also. So neutralizing is coming into the very framework where they say that neutralize the method so that at least once it gets taxed, it should not escape also, and it should not dual tax also. Controlled foreign companies. So a lot of time we have seen that although the parent company or the entity is located in X location, whereas activity is done in Y location, and which is completely controlled by a foreign company. So should we do a tax on them or not? That also becomes a part of action 3. Limitation on interest deductions. So interest deductions is becoming quite a good tool in hands of countries where there is a zero tax. So a lot of interest get earned in those countries and end up reducing that interest from the countries where there is a taxation. Let me take an example. Let's say Nigeria is taxing on the income, and you want to reduce the income. So what you do is you borrow money from UAE and end up charging interest in the Nigeria books, which reduces the tax. And in UAE books, when the interest comes in, since there is no taxation right now as we talk, no income tax is being paid. So technically speaking, this is also one of the method or one of the, you can say, practices which are used to shift the tax from a location of high tax to a no tax or a less tax jurisdiction. This also comes as a BEPS framework. If you just recall what happened in economic substance regulation, they started looking at these parts. So all the points which we are going to talk about in this 15 action plan from a BEPS framework, there are a lot of linkage which is being picked up, or which is the genesis of designing the economic substance. Although under the economic substance, we are not gaining, or you can say we are not collecting any tax from a UAE perspective. However, that tax gets aligned, or you can say assessed, in the country from where that diversion has happened. In my example, if under the economic substance regulation, you file a document stating that the interest is being charged to Nigeria, and that information is passed on to the regulatory authority of Nigeria, and you already have that database, and we can look at how these things are done. Objective of naming the country is not for anything else, just for the reference point. So I'm not saying that any country is trying, or any country citizen or nationals are trying to shift the profits or something like that, but this is just a reference point which I'm using. Harmful tax practices, again, there are mechanisms, there are treaties, or there are action plans which are used by the countries also to attract investment, and hence that action comes into play, where it is very clearly articulated that a country should not be creating such kind of a tax structure which is technically bring the investment but is harmful for other countries. So that's also comes as part of it. Prevention of tax treaty abuse. So wherever there are tax treaties or zero tax countries, what kind of treaties are happening between those two countries? Is there some kind of abuse which can work in? If yes, then joint collaborations being done with multi-countries to see that those action plans are taken care, and no one is allowed to use a taxation as a tool to shift the income without paying taxes. Permanent establishment status. So this is again one of the great point to look at, because whether you are doing a business or not, it does not only matter from whether you are registered in that country or not. If you have any establishment or work around, that also becomes a part of action plan, and you need to take care that how taxes are paid. Example, you have a company in a zero tax country, however you're operating in a taxable country. So giving a premise that we don't have any establishment there also becomes a point of contention from a BEPS perspective. This point I'm going to elaborate further also in the action plans which we're going to talk about, because UAE has adopted this as one of the framework from a corporate tax perspective, which we got through the questionnaires and other social media information which has come up. Action 8 to 10, these are talking about transfer pricing. So if there are businesses which are happening between related parties, how effective the transfer pricing is. Economic substance regulation also picks up this element. They don't pick up as a transfer pricing, but they're definitely asking about all the related party transactions or transactions which are done with a group company. That's a definition they're using. And if it is, then define what kind of a profit you earn from there. And so that's a pointer which comes from action plan 8 to 10. Action 11 is a BEPS data analysis. So here a lot of data churning is happening between the countries to see what kind of a profit generates, what kind of a profit exits the country, and is there any kind of a mismatch which is happening. So technically speaking, action plan 11 is more a data analysis and investigation kind of a thing, where any leakages which are there gets feedback to the countries, and there are treaties which are there. And I'm going to talk about something on FATF recommendations which has come up very strongly now. So those are also coming into this action plan 11. 12 comes, which says mandatory disclosure rules. So there are disclosures on account of income. There are disclosures on account of what kind of a revenue is being earned. That comes as action 12. Action 13 is country by country reporting. CBCR is what we used that as a terminology. UAE initially came with a regulation, and they changed it at a later stage, where they said that CBCR reporting requirement will be only at a parent company level. That is ultimate parent company where it is located. And that data is directly getting shared in the country or from the country from where the parent company is located. So that's where it comes into play. Mutual agreement procedures and multilateral instruments. So this is where a lot of country level data is getting shared. and a lot of information is getting connected, which can be a legal procedures also for picking it up. So this is also one of the action plan which is there as a part of FATF recommendations. Now, if you look at the stars which are coming up, which is action plan number 5, 6, 13, and 14. So these are all minimum standards, so which is mandatory for all 141 countries which we talked about to implement. Now you can see how the genesis of corporate tax is coming up. So this is one part, but coming from this action or coming from this status, something called GLOBE, which has come up, which is Global Anti-Base Erosion Rule, which is again part of the BEPS framework. Now, just a very quick snapshot on this, because this has quite a bearing on how the UAE taxation is going to be implemented and why it is implemented also. So it says where MNE, that is Multinational Enterprises Group, has euro 750 million or more of reported revenue in at least 2 financial years in 4 years, period immediately, then what they do is they are going to tax them with a minimum threshold or a set of a minimum taxation, which is defined as 15%. Now, what happens in this case? In case if we have a MNE group in UAE, and while calculating, we identify they fall under this category of 750 million revenue, then by default, minimum taxation of 15% has to be applied. Now, who get that taxation? The tax is being received by the one level up. That means the parent in where the taxation is applied for, because it is assumed that those taxes are shifted to UAE. Now, if this 9% tax, corporate tax, would not have come up, all this 15% would have gone to one layer up country. Rather than that, it's good that UAE has come with a 9%, so at least 9% stays here, and then balances what need to be done goes into the different country. But only action plan, just to reemphasize here, is the threshold is euro 750 million. So any company which is beyond that only comes into this criteria. Otherwise, it does not come. So it's only for a very large corporates which we are talking about. Now, under tax payment rules, so this is where we talked about. Under tax payment rules denies deduction on imposes source-based taxation for payments to related entity if that payment is not subject to tax above the minimum rate tax. So minimum rate tax is 15%. If it does not happen, then the country which is over and above the taxation structure gets that kind of a revenue. So this is where you can see how the taxation framework has been working into. Now what? So UAE has done a lot of things of late on the tax compliance, or you can say in the overall framework. All are related. Some places we got the perspective we are heading into. Some places we are still tumbling around. We are trying to see how we can connect it out. You will see a lot of actions or a lot of things which you may not at a first glance identify this to be a part of a tax framework, but this is. And let's understand what and why these things are important and to be connected when we are talking from a taxation perspective. So if you see on 1st January 2018, we got a value-added tax which is implemented. Excise implemented just around the corner towards that period. So there is a very clear indirect taxation implementation which comes and played an important role. On 16th May 2018, UAE has become the 116th jurisdiction to join the inclusive framework of BEPS. So as we looked at the current status of November 21 is 141, but UAE was 116th country to join the BEPS framework. So that means we got committed that we will work jointly with all the countries who are part of the framework. Now, what is a push? Why every country wants to be part of the frameworks? Now, this is a very interesting point to understand. There is no compulsion for countries to join the BEPS framework or OECD framework and all that stuff, but definitely it is one of the most important thing to do that, because it's kind of a society. So if you're not part of the society, you are being left around. I normally give a very simple framework. In olden days, when we used to work in a closed-knit society, if you are not able to join the society in a right order, you are being left out of the society. That means when you're left out of the society, you're not being inclusive in the development, in the social activities, or in any kind of activities which you're doing. So imagine if a country does not join a broader framework, you are out of lot of infrastructure things, lot of investment things, lot of social connect things, and hence it's technically not possible for any country to be left around. So that's the reason countries are joining, and when they're joining, there are some obligations which comes as part of the joining process. So this is where 16th May 2018 becomes very important, because UAE has taken a stand that yes, we want to be part of the inclusive framework. We want to be part of the BEPS framework, and we want to help other countries to collect the taxes which may not be collected by them, because maybe UAE was a zero taxation, so people are transferring the money. So we want to be part of the process and help countries to identify any kind of a tax leakages or any kind of a revenue shifting, and help those countries to collect the tax. Let's remind ourselves, in the whole process, UAE is not collecting any taxes as we talk till date. What UAE is doing is UAE is helping other countries to be part of the activity or be part of the process which is working on. On 23rd September 2018, AML CFT framework got implemented with a refresh. The law was before also there, but a refresh has happened and a lot of changes being included in that process. This is where DNFPBs, all accountants, auditors, including part of DNFPB, were pushed into the AML framework. So again, that is one of the part, because when we say money laundering, I'm not talking about terrorist financing, I'm talking pure money laundering. Tax evasion is one of the aspect from a money laundering perspective. So this framework also brought up a lot of action plans which UAE is implementing. Right now, we are not in a good shape from a overall country perspective. We are being defined as a grey listing, but nevertheless, if you see the journey which is being achieved from 2018 till today, it's commendable. All the regulatory bodies, all the international organizations have very clearly articulated that UAE has done quite a lot activity. Yes, there are some action plans which need to be further looked at, and country is quite determined to make sure that we are in the right space. Next comes in 2019, CBCR requirement got applicable, where MNEs are required to report based on the financial reporting year, which is starting after 1st January 2019 and later. So that is where the reporting requirements also start up in that place. 30th April 2019, economic substance regulation, we still are finding this as a good challenging activity, because one, it is new from a country perspective. Two, there are some clarifications which are still coming up. So the latest clarification which came, what is defined as a assets, or what is defined as a current assets from a books perspective. So there is a lot of things happening on economic substance regulation. Since we have already filed almost 2 years of ESR reporting, that reporting is getting shared with the countries which are a part of the inclusive framework. So this data is not only resting within UAE, this data is moving to various countries where those regulations are implemented. In 2020, beneficial owner status or beneficial owner resolution came up, where now it is mandatory to define and clearly articulate and provide the documents also of the beneficial owners who are part of the organization. So these are some of the framework which are getting attracted to, and in 2023 we know that corporate tax implementation is happening. So if you look at the whole gambit or a whole action plan, why taxation is becoming an integral and important part, because of all these steps which you're talking about. Now let's quickly recap the whole slide which is there in front of you. Value-added tax made sure that all the revenues, that means I'm talking about a sales at least, top line, are getting assessed, are getting audited, are getting verified, are getting validated. So revenue is being taken care of. AML framework has put up a lot of regulatory activity on account of whether transaction is genuine or not. There is no layering of transaction. We know whom we are dealing with. Beneficial owners got opened up. Now, corporate tax is putting one more, I will say, a stronger part from an AML perspective, because so far, taxation and value-added tax and excise was helping to audit the sales. Our expenses were not getting so far audited if you're not claiming an input tax. So, but now that is also becoming a part of the corporate tax implementation framework, where even the revenues and the expenses both are getting part of the action plan, which we are going to talk about. Now, last slide from an OECD perspective. So there is a substantial similarities between the technique used to launder the proceeds of crime and to commit tax crime. So this is where the tax crime has, if you want to crack the tax crime, we need to create a structure. We need to put a taxation. UAE is coming up with a very low taxation in comparison to other countries. However, the objective is much bigger than the collection of revenue. Collection of revenue is, yes, definitely a task. It is a product which is important, but overall, if you understand why this taxation is coming, that becomes a very important factor. So if you see, criminal activities are done when there is a secrecy, when there is a inadequate legal framework, or tax regulations are weak or not there, or weak interagency cooperation. Let's say example, if two countries don't cooperate with each other, it's very difficult to get what is happening between the two countries on account of tax evasion, on account of moving of funds. But all these factors, if you see on the top, including secrecy, inadequate legal framework, tax regulation, and weak interagency cooperation, is being taken care by the BEPS framework and is getting taken care much more as we move around. Now, this is the open point which is getting closed. And just to give you a broad thought process, which comes into 2/3 of all illicit flow involve tax evasion. Now, tax evasion includes direct tax and indirect tax. We're talking both. So that is where, and that is the size of correction or rectification they're putting it up. I can vouch for last 3 to 4 years. We have seen quite a control on direct tax and indirect on all the direct taxes which are there, which is coming up, and indirect taxes are getting quite effectively implemented in the country. So this is where things comes into. A last slide on a AML framework. If you just correlate some of the pointers which are there, are defining us and are pushing us to get into a right framework, right taxation story, and right activity which needs to be done. Why every step is important? One is, now these are 7 pointers which has come up from a FATF perspective, Financial Action Task Force perspective, to see how the taxation is implemented and how the taxes are demonstrated into. Now, demonstrating through case studies and statistics in a sustained increase in outbound mutual legal assistance, a request to help facilitate investigation of targeted financing, money laundering, and high-risk predicates. So this is where the regulations are coming up, and where we have seen how these mutual legal assistance or agreements are getting framed into. Identifying and maintaining a shared understanding of money laundering and terrorist finance risk between DNFPB sector and institutions. So this is where DNFPB are being talked about in quite a heavy way. A lot of actions are being vouched for from a regulatory authority. They want to look at how the STRs are getting filed by financial institutions and DNFPB, suspicious transaction reporting or suspicious activity reporting. That becomes a level playing field for the corporate tax also. So I'm connecting all the dots from the activity. Achieving a more granular understanding of risk of abuse of legal person. That means creating a parent company, creating a structures, all those things can be abused also. There are good case studies, there are bad case studies. So what the action plan is talking about the bad case studies and see how we can arrange for it. Providing additional resources to FIU to strengthen its analysis function and enhance the use of financial intelligence to pursue high-risk money laundering threats, such as proceeds of foreign, predicate offense, trade-based money laundering, and third-party laundering. So this is where, so if you see, all these are coming as a part of a transaction analysis, where either on account of direct tax or indirect tax, if there is any evasion, it is getting pushed into to make sure that things are rightly demonstrated. Demonstrating a sustained increase in effective investigation. That means if you find something, how you investigate, how you conclude, how the funds are maybe even frozen, All those things are becoming an important part, and proactively identifying and combating sanction evasion. Sanction is a different topic than the money laundering, so I'll not put too much of analysis on that, because we're talking more on the money laundering part, which is directly related with the tax evasion. So my point of bringing all those action plans are, see, taxation is not about only the taxes which you are going to pay. What we are doing is we are creating a transparency. We are creating a trail of the transaction. We are getting into governance ecosystem where even a search and seizures can happen. So any step we take is getting tracked. Any action we take is getting monitored. So the objective of getting into a corporate tax is not only for a taxation perspective. We are creating a complete trail of transactions, and that can be used in a more effective way by the regulators and organizations to see any kind of a money laundering aspects, and that's how it becomes much more important and integral part of how the framework is working in. I'll give a pause here to just to for you to ponder around and think through the impact and the activity which we are getting into. So corporate tax is fine. We know the taxation is going to come, percentage is defined, but why is more important to look into the framework. Perfect. Now let's jump into what UAE is doing and what kind of a coverage is going to happen. What kind of activities which we believe are going to be there from an action perspective. As we talk today, there are two broad factors which are going to take a change from a organization or from a country perspective. Right now, we have an Emirate level corporate income tax. I'm sure a lot of people know that there are taxes which are charged by Emirates. Name can be different, so I'm not getting into the naming convention, but there is definitely a corporate tax which is being applied majorly to industry. I'm going to talk about that. Free zones have a corporate tax holiday. So all the free zones right now have a tax holiday. So what is going to change as we talk about? So there are two industries. One is a foreign bank and one is a foreign oil extraction units or oil companies engaged in upstream petroleum activity. So this is where it comes into. So Emirate level corporate income tax is there right now as we talk. United Arab Emirates does not have a federal corporate income tax, which is right regime. However, corporate income tax is levied by the government of individual emirate. So at an emirate level, Sharjah has a different structure, Abu Dhabi has a different, Dubai has a different. So I'm not going to bring up all those elements here, but there is a taxation which is there for foreign banks and especially for the branches of a foreign bank and foreign oil companies engaged in upstream petroleum activity. So this is more from an information perspective. Do we have a taxation in UAE? Yes, we have, but it is not at a country level. It is at a Emirates level. So which comes into play. Now what's changing? So if you see corporate tax from a free zone perspective, there are corporate tax incentives currently being offered to free zone business with the benefit of corporate tax holidays. So there is a lot of discussion on this topic also, that free zone will not be taxed at a later stage and all those things. Before that, I think we need to understand the objective and the meaning of the tax holiday which is being given and what is going to change after that. So ADGM provides with 50 years, that is 0% corporate tax holiday and access to an extensive network of double tax treaties. So this is where from ADGA website we have picked up the information. DIFC provides 40-year guarantee of zero tax. Now these taxation documents are not in public available. However, if you go to the respective free zones, you will identify 50 years, 40 years, and all those statements which are there. I don't have access to the federal document which gives an authority for a free zone to give that benefit. But definitely, we have seen in the corporate tax questionnaire also where it is very clearly articulated. There will be benefit given, but those benefits will be within the framework. Now, what is a framework? So before getting into a framework, let's understand what free zones are all about and what kind of a taxation regime they get into. So we'll talk about that because that I have put up as an action plan on how these things are evaluated. Now let's look at what is introduction of corporate tax. I'm using word federal in the UAE because as we have seen, we already have Emirates level taxation. Now, what happens when it comes at a federal level? So there are actions, there are jurisdictions, and there is an action plan which is being very clearly articulated. Corporate tax is a form of direct tax. We all know that it is levied on income, which is after allowing all the allowable expenses, not like all expenses, all allowable expenses from a corporate tax regime perspective. We don't have a complete granular story of what will be allowed, but yes, from a question and answer, we have seen and analyzed some of the aspects which will be disallowed, and we are going to talk about those elements as we go along. Now, corporate tax is sometimes also referred to as corporate income tax or a business profit tax in other jurisdictions. So that's what we just interrelating into. Naming is not important, but the objective and through which what things are being done becomes an effective part. UAE corporate tax will apply to all UAE businesses, except now they have given a very clear exception: extraction of natural resources, which will remain subject to Emirate level corporate taxation. So they have eliminated natural resources activity. Now, if there are businesses which are doing multiple activities, and within that framework, natural resource extraction is one of it, it becomes important to see how we segregate those profits or segregate those businesses, or does it make sense to have a separate entity itself so that there is no confusion on those activities. So those things becomes part of a decision making, or you can say part of planning stage from now itself. Foreign entities and individuals will be subject to corporate tax only if they conduct a trade or business in the UAE in an ongoing or regular manner. You remember we have talked about place of establishment or the activity which is being conducted. Here also something similar comes into the definition from a foreign entity perspective. I'm going to talk about that also as we move along. UAE corporate tax will apply equally to all category of profits and other income reported in the financial statement prepared in accordance with international accepted accounting standards. So there are a lot of riders which are given in this single definition, and it's very important to maybe dwell around and take those elements on a separate basis. So first is UAE corporate tax will apply to all UAE businesses, full stop. So there is no ambiguity that if it's a business, it is a corporate entity, it is a legal entity, it will be applied. Except for extraction of natural resources, which will be remain at Emirates level corporate tax. So any kind of extraction or natural resources activity will be out of the ambit of UAE federal tax. There will be a taxation, but that will be at an Emirates level. They will decide rate, procedure, method, and all those stuff, which will not be covered in the corporate tax, which we're going to talk about right now. Foreign entities and individual who are subject to corporate tax only if, that means it is only applicable if they conduct a trade or business in the UAE in an ongoing or a regular manner. So we have seen similar kind of a definitions when the VAT or value-added tax got implemented in UAE, and it gives a lot of clarity on how things will be implemented from that perspective also. So we have a parallels, we have some similar methods which are used in various countries, which is what we are going to talk about also. Now, the most important thing which comes is how accounting need to be done. It has to be internationally accepted accounting standards. So that means we need to engage with professional accountants and auditors, and the people who are into this capacity need to refresh and see and advise back to the clients how the books need to be maintained, because that's going to be the standard. That's going to be the mechanism with which accounting need to be done. Now, so we have looked at, and I'm going to break up all those elements as we move along. Corporate tax is a form of direct tax levied on net income or profit. We have looked at already. It is referred to the various names. We call it a corporate tax or a business profit tax or whatever name we call about it. Now, why is UAE introducing corporate tax? So we have heard that in the previous BEPS framework, but just to reemphasize back again, corporate tax regime is based on international best practices to strengthen UAE position as a leading global hub for business and investment, and acceleration the UAE development and transformation of activities, its strategic objective. So basically it's looking at two broad activity. One is international standard for tax transparency and preventing harmful tax practices. You have read these as part of the BEPS framework. Now you can relate to why we are talking about what we are talking. So this is where it is important to understand also why the taxation is coming up, and these are the framework which are very important to connect and get into right perspective. Tax transparency is the most important thing which is coming up, because once you have a tax transparency, you are expecting business houses, corporates to maintain the books which are accepted under international accounting standards. So that means you are making UAE business in parallels to the framework which is there at a global level, and preventing harmful tax practice. So these are two framework which are pushing up for an action plan. Now, when the corporate tax will be effective, 1st June 23 is what being defined as part of the questionnaires or part of the ministerial information so far, what it stands for. So 1st June 23 is perfectly fine. Now, let's look at some examples which will relate to when the financial year will start from, or when the corporate tax applicability will start from. Let's say your financial year is July to June. So that means the next month which comes from June is July. So that means you are going to the first starter. So 1st July 23, it will be applicable for these entities. Jan to December, then it will be from Jan 24, because the first financial year is starting only from 1st January 24. And if you're April to March, then 1st April 24 is when your first corporate tax period starts. Now, can we change the financial year? A lot of things have come up. A lot of people have asked for. You may attempt to, but there are a lot of linkages which are being so far done. Your economic substance regulation is attached to this financial year. But can we attempt to? Can we apply to? You may try to, but I don't see too much of benefit coming out from that framework. So, but this is the financial year's period which are being defined and which is expected to be starting from. Let's look at what are the scoping, or what kind of a scope of activity which comes into play. So there, the tax is defined, which gives a scope, exemption, and rate of corporate tax. How this is being designed. Under the coverage side, all activities undertaken by legal entity will be deemed business activity, hence within the scope of corporate tax. Now, the legal entity means includes business income earned by an individual or legal entity under a commercial license. So it does not differentiate individual here. If you have a commercial license, whether it's a sole proprietorship or whatever, it comes as part of a corporate tax, or he's obliged to be registered by the virtue of legislation. So this obliged to is a word which you have seen in various regulations also. If you're not even registered the company, it does not make a difference. You will be required and you will be part of a corporate tax. Now, what other penalties, fines will come for not registration? We are not going to talk about that, but that's how the corporate tax framework comes into. I'll give you an example which we have drawn up, which gives quite a activity on what is defined as a legal activity and how it is being covered into. From a coverage of corporate tax authorities may not be concerned about manner or means of acquiring income. I'm not saying in this case that illegal activity by paying tax becomes a legal income. No way. But from a tax perspective, income earned, whether legally or illegally, becomes part of a taxability. Don't take the statement otherwise. It does not mean that doing an illegal business, paying taxes, legitimize the income. No, that is not the case. We have seen in various parts of geographies where if there is a tax evasion and that comes as part of our discussion, there are other framework or other legislations also kicks into. So an important point of this slide, just to make sure that we are not, I'm not being understood in a different way. Taxing an income does not legitimize the income. So that's the underlying statement which we are referring to. I'll just give a perspective. If there is an income, there is an illegal income, and income tax is being imposed, corporate income tax is being imposed, you may get hit by various other laws or various other framework on account of which failure has happened. Illegal income can be on account of money laundering. So you end up paying income tax, but you will be prosecuted under the Money Laundering Act also. This may be a fake product. If it is a fake product, you may be prosecuted under the under the respective legislation from that perspective. It can be a VAT evasion, it can be a customs evasion, whatever has happened. So paying income tax does not legitimize the transaction. You may get prosecuted or fined. The corporate may get fined on the various other parts also. So we need to read this statement in a very effective way, that paying income tax does not legitimize the income. Again, want to get through this slide in a more effective way so that you get a perspective. Tax authorities may not be concerned about manner or means of acquiring income. I'm talking only tax authorities. I'm not relating to other things. The income might have been earned illegally or resorting to unlawful means. Illegality has no bearing on the taxability. Now, in this case, we have looked at how the suspicious account reporting or suspicious transaction reporting is mandated from a AML or anti-money laundering perspective. Now, if tax authorities identify that there is something wrong which is happening, although they will tax the income, in the parallel way, they will pass on information to the respective regulatory authorities to take action on the other side also. So that is where both the connects or both the dots get into mapping side and may get into a very different tangent discussion. Absorb this slide. This slide does not say that only one. And we have seen wherever in various countries, wherever the tax authorities send a notice, you will suddenly find enforcement also has sent a notice. You will suddenly find the excise department or a custom department or a indirect tax department has also fined the notices. And those things becomes part and parcel. So it's not a one case. You will end up having maybe 10, 15 cases which are interrelated and interconnected on those activities. Perfect. Looking at a coverage, a taxable income will be accounted net profit of a business after making adjustments. Now, these adjustments for certain items to be specified under corporate tax law. I'll just give a very simple definition and our understanding that depreciation will be a percentage of depreciation will be defined in the corporate tax. So if you are taking a depreciation which is higher in your financial books, which is fine, you can take based on accepted accounting principles. But when a corporate tax defines a certain percentage of allowable expenses or under the depreciation, you have to adjust the taxable income based on the depreciation defined. So there is definitely going to be a reconciliation between financial books and tax books or a tax calculation where disallowable expenses will be called back. That means you add up that in the income again. There can be incomes like expenses like director's remuneration, which can be a shareholder's profit also, which need to be clawed back or you need to be brought back from a taxation perspective. So those adjustments are going to be very important and need to see how these are permitted or brought back into the books. The accounting net profit of business is the amount reported in the financial statement prepared in accordance with internationally accepted accounting standards. Now, corporate tax is applicable to income earned from activities carried out by businesses, including freelance or permit. So there are a lot of discussions, a lot of inquiries on people who are working on the freelance visa. They have a proper freelance license. The question came up whether they are going to be taxed from a corporate tax perspective. Answer is yes, they will be. Now, there is a little bit of articulation which is there from a taxation perspective which comes into, and we will talk about that. Corporate tax will be applicable to all UAE businesses and commercial activities with an exception. So exception is being defined into, and we'll see all those exceptions how it comes into. I'll just take you through one. Perfect. Income exempt from corporate tax. So as we talked about, there are again coming from the questionnaires and the information which we receive from the ministerial side. Dividend capital gain. Dividend capital gain earned by UAE businesses from its qualifying shareholdings will be exempt from corporate tax. Now, the qualifying shareholding will be defined in the corporate tax law when it comes into. It can be investment in the Dubai Stock Exchange or Abu Dhabi Stock Exchange. So it can be investment within the UAE entities if it is done. So dividend and capital gain may not be taxable in the hand of corporate and individual, and more details will be looked at how these are being framed out. Ownership interest in a UAE or a foreign company that meets certain conditions, which is where we will look at how the corporate tax law defines it and need to be done. But at a broad level, we can easily say that dividend and capital gain are not going to be taxed. Intergroup transactions. Again, these are intergroup qualifying transactions. So when there is a group being defined, let's say you have 4 or 5 companies and you defined as a group entity. If you do any transaction between that, will not be taxable because you are going to technically tax at a group level. So you take one exemption limit and you pay taxes based on the holistic of a group. So that is where the whole activity it comes into. Income from free zone business. Now, free zone business will be subject to corporate tax, but corporate tax regime will continue to honor the tax incentive currently being offered to free zone business that comply with all regulation requirement and do not conduct business in mainland UAE. Now here, there is a lot of conversation on this topic that free zones will be out of the purview of taxation. That's not right. There will be taxation, but yes, if the free zone is only doing a business within the structure which is being defined, then there is a potential that you may get an exemption. Now, do we require to file a tax returns or not? Yes, free zone will be required to file the tax returns. That means there will be standard or there will be a clause based on which the tax exemption will be provided on a certain income. And those income calculations will definitely be a task to be worked upon. From a free zone perspective, I always say, let's look at the legislation. Let's look at articles and memorandum which we have. Let's look at a legal framework which is defined by the free zone. Maximum free zones do not allow businesses to be done outside the free zone or outside the UAE activity. Still, maximum free zones are doing business within UAE, and the taxability of those entities will be very different than what is being not defined into. We talked about the exemption will be there from businesses which are in extraction of natural resources. So this is again exemption from a country level corporate tax, but at Emirate level, these things will be taxed. And how this will be taxed, again, we have to go back to the Emirate level legislations, and the taxation need to be looked at separately. So this will not be a federal tax. This will still remain a part of a Emirate level corporate tax. Now here comes from an individual perspective. Now, where do you think, do we think that individuals are going to be taxed, and if they are going to be taxed, what rate they are going to be taxed? So all those framework are part of taxability from a individual perspective. It's important to understand what is business and what is personal transaction. So there is a lot of ambiguity on this process. Let's see with some example. I picked up 2 examples giving some reference to a UAE business model, and where we believe that these are either taxable or not. A simple case: an employee who is sitting in the office just logged in to a portal where online cars are being sold. So he went into an e-commerce platform, identified a nice car at a good deal value. He locked that deal by paying a token money. Just to remind you, the vehicle transfer or vehicle execution has still not happened. It's just a token money which is being transferred and paid. Now, during the day, he was sitting with one of his friends, and while discussing, he told his friend that I have purchased this car through an online platform and I like the vehicle. The moment he told his friend said, "Why don't you sell this car to me?" The car which is just purchased few minutes back for 100,000 is ready to be sold for 150,000 to his friend, because one, he liked that model, he liked the condition, and he want to pay some extra bucks on the deal. So the deal was done. On the next day, they all went to, that means the seller, the buyer who has booked the deal in the e-commerce platform, and his friend who is ultimately going to buy the vehicle. They all went to RTA. The vehicle got transferred from a seller to his friend. That means the person who is ultimately buying the vehicle. And the difference of 50,000 is being pocketed by the intermediary, the guy who has booked on e-commerce platform. Now, do we call this as a business or not? I'll not give an answer right now, but let's hold that transaction and let's understand whether this comes under the definition of business or not. Let me go to the case 2. In the case 2, the similar story happened, but with a little twist. In this case, the gentleman was sitting looking at an e-commerce platform, liked the vehicle, purchased the vehicle, or you can say booked the vehicle for 100,000, went to RTA with the seller and buyer, took the possession of the vehicle and got it transferred through RTA. Next day or few days after, he was sitting with his friend and his friend liked the vehicle. He said, okay, I'll pay you 150,000. The gentleman thought, let me pocket out 50,000. Maybe I paid some kind of a fees for RTA for transfer. That's okay. That's still manageable, not a big money. So I want to do this transaction. Now, in this case, when the transaction was executed, the next day, the person who has purchased from the e-commerce platform and his friend went to RTA, executed the deal and got the deal completed. Now, out of the case 1 and case 2, which is a situation will you believe that this is a business and which is considered as a personal transaction and should not be eligible or should not be coming under the preview of a corporate tax? So if people can just put some comments on the chat window, it will be helpful to see whether we are getting into the right space. I'm just opening my chat window to see the comment. Whether you call case 1 as a taxable or a case 2 as a taxable. Case 1 is taxable, case 2 is not. Suraya has confirmed, Mohammed has written that. I'll wait for a couple of more. Case 1 is taxable as per Islam also. Manoj also is writing case 1 taxable and case 2 not. Ala is saying both won't be taxable. Christopher, case 1 taxable. Priya, case 1. Joseph, both cases and case 2 are not taxable. Both of them are not taxable, Bathina. From sellanycar.com perspective, the sale of the first buyer is taxable. Perfect. Getting a good understanding on the perspective. Thank you very much. I'm just closing my chat window so that I can come back to the session. So you look at the transaction. So I think the case 1, it's a very clear. It's not a sale and purchase of transaction. The person who has booked the deal in the e-commerce has not acquired the asset. He just dealt and became a broking person to fetch a revenue in process. So this is a 50,000. Still, it's okay. But if it's a regular business, imagine this gentleman is doing this kind of activity on day in, day out basis. Although he's individual, will he not be required to subject to creating a company and doing this kind of a business? This is where he's obliged to register, and the tax definitely comes into play. Forget about corporate tax, which is going to be coming up. This is applicable from a VAT perspective, from an indirect tax perspective also. That's the first point. Point number 2, I'll use this word. I'm using a word I may take it out from a corporate tax perspective because this gentleman has acquired the asset for personal purpose and sold the asset. Now this asset sold maybe because of his taste or because of the better deal he was getting. And he's not doing this continuously. This is one of transaction which was done, may not get attracted from a tax perspective. So that's a difference which comes under the case 1 and case 2. And that is where the analysis becomes very important, how we connect the dots. So my perspective, as whatever information we know, case 1 will become attracted towards a corporate tax. Again, we need to look at the finer lines. And technically speaking, if you are doing this kind of a deals again and again, you may be required to register your business also, because you are doing a transaction which may not be legitimate without having an adequate license. So as we said, if something goes wrong, it does not stop there. The other action plans also comes into play. So if the person gets identified that he has done some 20-25 transactions in a year, this person may get taxed. This person may get a penalty for not registering a company and doing a business. So all those aspects comes as part and parcel of the taxation story. Case number 2 may not attract tax based on the information which we have, because these are personal effects and not done on a regular basis. So that's where I've used some assumptions to explain this scenario, so that we get and relate to what we are referring to. Perfect. Now, will an individual has a commercial license to carry on business in UAE be subject to UAE corporate tax? Business income earned under commercial license will be within the scope of UAE corporate tax. So whether it's a sole proprietorship or whatever activity, so far there's a commercial license, the taxability comes and become part of the UAE corporate tax. Let's look at quick definitions. I've already given a broad framework, but this is where maybe the final lines need to be looked at. Income earned by freelance profession, it's a taxable. Reds are all taxable under the corporate tax framework. Income earned under commercial license is taxable under the corporate tax. Salary income, since it is not an independent activity conducted by a person, it is not going to be taxed under the corporate tax because it is considered as an individual income. Further, real estate investment under individual capacity will not be taxed from a corporate tax perspective. There is a little bit of catch which is going to come up. I'm going to talk about the real estate a little more. Investment from investments, which is what we talked about, dividend, capital gain, will not be taxed and will be considered as an individual income or individual activity. Now, real estate has a little bit of a trickiness, because there are two kind of structures which people maintain from a real estate perspective. One, holding real estate in the individual name. Two, holding real estate under the corporate name, or free zones which are used for doing that kind of activity. How the taxability will come? Broad framework, it should not be taxed, but we need to look at more details and more answers from the legislation, how this framework is going to be established. Now, this is where it says real estate, that is investment in real estate by individual in their personal capacity, may not be subject to corporate tax, provided individual is not required to obtain a commercial license or permit to carry on such activity in the UAE. Now, this may create different tax structures based on investment in real estate held. Legislation will provide more clarity on the subject. So this is right now an open point. A lot of people are believing that let's close a company which is holding the real estate assets. I don't think so. It's a right time to do that. Maybe we need to hold the position and see how the legislation comes up before taking any action, is what our recommendation or comments are coming up on this section. Little ambiguous, but we are expecting, as we talked about, neutralized approach from a regulator perspective. Now, these are some of the statistics or numbers which are published by OECD. So average statutory corporate income tax rates by region, if you see overall Africa, Asia, Latin America, and OECD countries. So you can see various rates which are being defined and how it is being coming down. So in 2020, the rates were as high as 30+% in maximum countries. Now it is coming down, and it is less than, or you can say 27.5%, less than 27.5% approximately. So corporate tax rates are coming down. This is a very simple thing. The more governance framework comes into play, the rates tend to reduce because your efficiency and effectiveness of collection becomes high. So that is where it plays an important role. Now, this is where the percentage of jurisdictions. So if you see in 2020, 63% jurisdictions were into the ambit of more than 30% tax. In 21, it is only 16%. So percentage of jurisdiction with statutory corporate tax rate greater than or equal to 30%. So from 63% to 16% has come down. Quite a steep pull down, and we have seen how the other countries are reducing the rate of tax, but collection of taxes is improving, as we said. because of one, efficiency, and because of a lot of information which is being shared now. Developed countries have infrastructure to collect the information at various channels. Even developing countries are doing that right now. Because of the digitization, because the more you digitize, the more economy goes into the digitized world, you have more opportunities to trigger and collect and govern the taxes in a right way. How UAE is going to frame out? So we talked about multinational enterprises where annual revenue is more than 750 million euros. It may come under the 15% framework, but other businesses which we are talking about, which is what broadly we are picking up the discussion today, 0% up to 375,000, 9% above 375,000. So that's a single slab, or you can say a dual slab structure, which is being designed, where the taxes will be collected for. Quick calculation, just a simple example, income of 400,000 will be calculated as, so up to 375,000, you will not tax anything. Next slab of 25,000, you will be taxing 2250. So if you see the percentage, of amount collected is around, is less than 5% even. So 0.5% comes as part of it, the total taxation. So it's a very nominal taxes which are coming up on a whole transaction perspective. Now, what to do about the foreign person? So there are a lot of entities which are foreign entities and a foreign persons being defined into. So how we structure them? I can see some comment. Just give me a minute. It's strange you minus 375,000. What is the upper limit for second band above 375? There is no upper limit after 375,000. So the threshold is there. So 375,000 is a threshold. Yes, 375,000 is exempt. Is there a guidance about above MNC taxation? 375,000 is a threshold or a limit which is there. Beyond that, the tax will be applicable. And what we talked about from a multinational company's taxation perspective, yes, there is a calculation which need to be done, which is under the global minimum tax of 15% slab. If you can see that need to be looked at. So there is a slab rate. So up to 375,000, no taxation. Beyond that is going to be 9%. Is what so far the ministerial confirmations are coming up to. Yes, Mohammed, 375,000 is going to be exempt. So it's not going to be like a VAT. Once you register, you pay for everything. There is always going to be a slab and there is going to be a threshold. Beyond that, only taxes are going to be applied. Shailesh is asking if our corporate tax includes capital gain as well, then we need to remove the gain arrived at the taxable income. Yes, you are right. Whenever we are having any kind of allowable expenses or allowable or incomes which are not taxable, those adjustments will need to be done from a financial versus a taxability. So that is definitely there. For property owners, if the rental income is above 375,000, is eligible for corporate tax. Answer is what I gave you. If I just go back to the real estate, from a real estate perspective, investment in real estate is, as a first glance, is defined as out of the preview from a taxation perspective. But we need to see if these are held at a corporate level, what need to be done. So right now, property owners will not be covered under the corporate tax at a broader framework. Islam is asking, total income means net income after expenses, definitely, but you need to remove some expenses which may be disallowed, and you will need to adjust some incomes which are exempt. Then only you will arrive at the taxable profit. It's not going to be as plain vanilla simple as just pick up the financial profit and fill up your income tax returns. Example we talked about, if there is a capital gain for the incomes which are exempt, then you will reduce that income, right? And if there are expenses which are not allowed, you need to add up that expenses. So there is going to be a calculation, there's going to be a working which need to be done. Is income on property revaluation gain taxable or not? I don't think so. Property revaluation will be taxable. It is not taxable in maximum countries, but we need to look at how the legislation comes into play. Perfect. So I'll come back on the slides so that we can cover up some more, maybe a couple of more points before we get into the next section. We'll pick up these questions maybe immediately after the break when we come. We'll spend a couple of minutes to cover up these points and take it further. Now, tax implication for foreign persons. So this is where a foreign entity and individuals will be subject to UAE corporate tax only if they conduct a trade or business in the UAE in an ongoing or a regular manner. Now, this is where the taxation structure comes into play. Now, what is defined as a foreign entity, and that's where we need to look at one, the definition and how the taxability plays a role in that part. So if you see, a foreign person includes a non-resident alien individual, foreign corporation, foreign partnership, foreign trust, foreign estate, and any other person that is not a resident citizen of a country. Now, this is where the global definition comes into play. Generally, it may not include a foreign branch of a UAE company. So basically what we are looking at is a place of establishment or a place of active establishment which comes into play. Now let's look at very simple geographic picture. If you are a UAE tax resident, now what are the situations where a UAE tax resident can become? One, if it's a UAE company, that means registered in UAE company, having establishment of a UAE company, perfectly fine, no questions further to be looked at. Which can be a wholly owned or a partly owned subsidiary of a foreign company, does not make a difference. Which can be a joint venture of a foreign company, does not make a difference. So if it's a UAE registered company, you are part of a UAE tax structure and respective corporate tax jurisdiction or effective points comes into play. If you are a UAE incorporated branch office of a foreign company, that means you have a branch office sitting in UAE, which is of a foreign company, still you are a tax resident from a branch perspective in the country. UAE incorporated licensing office or undertaking UAE based project. Now, generally this is not possible from a UAE perspective, but still we have taken as an example. If you are undertaking a project also in UAE and you are doing an activity within UAE, your place of effective management comes into part of it and the taxation may come into the ambit of corporate taxation. So the basic premise we say is it's a registered company or it's anyway directly linked, connected with any company which has a place of effective management in the UAE during the financial year. Now, the financial year period and all those things will come up as a part of a corporate tax also. As we know, there is a very clear indication from tax residency certificate what all are covered from a UAE tax status perspective and what are not. So just to give you a quick snapshot of what is defined as a foreign person, although individuals are anyway not taxed, but still to give a full holistic definition of a foreign person, we have included them also. A foreign person includes a non-resident alien individual, foreign corporation, foreign partnership, foreign trust, foreign estate, and in the person that is not a resident citizen of a UAE country. Generally, it may also include a foreign branches of a UAE company. So look at from a tax perspective. So this is where the taxable structure or the taxable activities of a person comes in, plays an important role. I'll give a pause here on the slide before I move to the next one. Now, there are two things which are becoming important here. What is place of effective management? Now, this is a legislation wise. We need to wait for how it comes into, but I have just picked up some of the common factors, some of the common framework which are used in various countries. In order to understand the tax residential status of any company, it is important to briefly understand the concept and place of effective management. Now, this is again part of a OECD framework from where effective management comes into play. The definition of place of effective management may mean a place where the key management and commercial decisions that are necessary for the conduct of a business of an entity as a whole or in substance are made. The concept of the place of effective management is internationally accepted, and various tax treaties entered speak about concept of a place of effective management for purpose of deciding the tax resident status of any company. So if this is where the foreign control entities also become part of it. So it's going to be a very tricky and very detailed one, how this is being defined. Because once we have a place of effective management, maybe the profit of companies which are earned outside, which may not have a taxation of a 9%, may come in the ambit of the holistic activity which we're talking about. So this is where if you just relate to all these pointers on a foreign person and tax resident status, anything which is incorporated, registered from a UAE perspective will be taxed. Place of effective management, all these things play an important role to design whether the foreign person is doing any activity in UAE or not. Just a typical example where e-commerce companies are providing services in UAE and they do a business in UAE. As we know, if the thresholds are achieved, they are supposed to have indirect tax registration, like VAT registrations are being taken by them. Now, from a taxation perspective, also it will come what kind of a controls, what kind of a mechanisms, what kind of a management which is being taken care in UAE. Is there someone else who is going to pay a taxation on the income earned by them? And also the transfer pricing mechanism also plays an important role in all the ambiguity. So this is going to be a good discussion point and good understanding point from a foreign company perspective. But the law is clear. If it is a foreign company and they don't have a place of effective management or establishment in the country and they don't do business, regular business in UAE, they will not be taxed at a first glance. So this is where the framework has come up, but we are getting a little more into detail on how the effective management framework comes into play.